Balance of payments. There are two components to balance of payments. They are the current account and the financial account. The current account consists of four parts: balance of trade in goods, a balance of trade in services, income, and current transfers. The financial account consists of three parts: direct investment, portfolio investment, and reserve assets. Another way to define current account is the sum of the capital account, financial account, and errors. The capital account has two parts: capital transfers and transactions in non-produced, non-financial assets. Don't worry too much about the capital account, as the current account and financial account are what's important to know when it comes to balance of payments. On to terminology. Receipts are inflows into either the current or financial account. An inflow is something that will generate more demand for a currency, leading to an increase in its exchange rate. A payment is the opposite of a receipt, and is an outflow to either the current or financial account. An outflow will generate a supply of a currency, which leads to a decrease in the exchange rate. Let's look at some of the examples of inflows and outflows to the current and financial account of Canada. Examples of inflows in the current account are exporting goods, exporting services, Canadian firms making a profit abroad and sending the money back to Canada, or an individual. Examples of outflows in the current account are opposite of the examples of inflows. So importing goods, importing services, or a foreign worker in Canada who sends money back to their own country. This is an import of labor, and the export that we've talked about earlier is called an export of labor. Examples of inflows in the financial account are incoming investments. So a foreign company investing in Canada, foreign banks lending money to Canadians, or the Bank of Canada decreasing its supply of foreign currency and receives Canadian dollars as a result of buying our own currency using foreign currency. Examples of outflows in the financial account are once again the opposite of the example of inflows in the financial account. Canadian companies investing abroad, Canadian banks lending money to foreigners, or the Bank of Canada increasing its supply of foreign currencies by purchasing more foreign currency using CAD. And finally, some terminology: net borrowers, net lenders, debtors, and creditors. A net borrower is a country that borrows more from the rest of the world than it lends out. A net lender is a country that lends more to the rest of the world than it borrows. Most countries are net borrowers. A small number, like Japan and Saudi Arabia, are net lenders. A country's status as either a debtor or a creditor depends on its stock of foreign investment. A debtor is a nation whose stock of outstanding debt to the rest of the world exceeds the stock of its own claims on the rest of the world. A creditor is a nation that has invested more abroad than foreign firms have invested in it. As more countries are net borrowers and debtors, is that a bad thing? That depends on how the country is spending that money. If the borrowed money is going towards things like infrastructure, healthcare, and investment, then the borrowing is not a problem. But if the borrowed money is being used to facilitate consumption and injections without considering growth, that is not very sustainable for the country, and eventually the money will run out.